Time to have a look at the markets picture now. The Asia-Pacific markets plummeted, with the Japanese markets leading the losses in that particular region. Majority of those losses came from the automakers listed on that particular bourse. Elsewhere, the Chinese, meanwhile, left their benchmark lending rate unchanged. When you look at those particular markets, also a little bit mixed. However, in Hong Kong, we did see some negative performance on that particular side. Looking at the European picture right now, at this particular point, it's investors trying to digest what we heard last week, Wednesday, with the FOMC markets. The markets on that particular side looking a little bit choppy. And of course, it's that hawkish tone that everybody seems to think was a surprise. Was it not a surprise? Those are some of the elements we're going to get into with our particular market watcher for today. However, when we look at US futures at this particular point, looking a little bit higher. Locally, we had markets news out of the companies such as Naspers. They published their results. You may have seen the interview that I did with the chief financial officer. We also had PPC release their numbers as well, affected by currency fluctuations as well as COVID. But to get into what happened on the local bourse, the JSE in particular, we are joined by Bright Khumalo from Investec Asset Management. Bright, thank you so much for your time. What do you make of the JSE at this particular point?
Yes, I mean, I think you've introduced it very well, talking about, the hawkish tone that we've seen from the US Fed. And obviously that sent basically global markets tanking, towards the end of last week after their meeting, their two-day meeting when they met last week. So, and obviously, the other Fed chair of, St. Louis also coming out and saying that maybe rates will start increasing in 2022, and obviously 2023, they've already penciled in a minimum of 2 rate increases. So the reflation trade is basically back on the table, and investors, I don't know at this point what they think they should be doing with it, but right now people are just taking money out and watching from the sidelines.
Was it a surprising tone, as media outlets seem to suggest, whether it's the Wall Street Journal or any other analyst? Some seem to think it was a surprise. Others say, but given the data, it shouldn't come as a surprise, because the whole idea or the argument that inflation is transitory doesn't seem to hold right now. So were you surprised at all?
I think so. Post the inflation numbers showing 2 consecutive months of increase, we're talking about the month of April and the month of May, and going all the way to, I think it was 2006 or 2007 when they last increased so much. So obviously we knew at that point that it wasn't transitory, and anyone who said it was, they're probably a little bit, I wouldn't say skeptical, but they're not looking at things the way they're supposed to look at things. Because, reality is telling you that prices are increasing across the spectrum, which is why, again, the big manufacturing companies have, been seeing a lot of growth as of recent because of the similar trade. So if you're not listening to the numbers that are delayed, maybe the market is your friend by telling you what's going on. So you either have to listen to the one or the other.
All right, so we had numbers published out of Naspers and Process. What did you make of those from an analyst point of view?
I don't think there were any surprises there, because we know, I think there's been too many, or should I say actually very good coverage by the media with regards to the Tencent asset, which is still basically, 120% of their assets there. All their businesses outside of Tencent are still making big losses. We've seen that from the loss numbers they're showing, even though core headline earnings per share, showed an increase north of 20%. But that's not what we want to see. We want to see what the management is going to do for the individuals or the shareholders, that own these shares. And obviously, if you can't do anything more, than Tencent, rather than trying to be creative and cause further tax headaches for all your shareholders, post causing them headaches already from the the unbundling off process, which was meant to actually close this gap and has opened it even more. So it's a big mess. But instead of doing all of that, just unbundle the shares, the Tencent shares, to individuals, give them a choice whether they want to stay with one or the other, or just unbundle it 100%. give it to them and stop being too creative and just focus on all of your incentives being on actually growing these businesses that are actually making big losses for the company.
Right, as it stands, the process share up 1.6%, and Naspers, as it stands right now, up 0.1%. Speaking of Tencent, what do you make of the big tech companies in the US? If you had to compare, their performance right now versus where they were during the pandemic.
Look, most of them are still relatively higher. Obviously, the ones with the ones that were basically the beneficiaries of COVID, the likes of Amazon, anything that had to do with online, and you had little to do with outside entertainment. So if you were a Netflix, we're talking about, staying at home entertainment and all that. They've seen a massive, benefit from, the COVID era and obviously post-COVID. But the businesses that we're watching really closely, which has actually, were left for dead in the tech space, where, things like Expedia, Booking.com, and maybe even Airbnb, even though it wasn't listed at the time, those businesses, did very, very bad. And obviously now that they didn't actually go under, shareholders are seeing a lot of value coming out of there, and those actually have outperformed the ones that were stable in that period. But obviously, if we're looking at a a year-on-year comparison, it looks like the other one has done better than the other one, but the ones that were more resilient have done much better in the longer period if you stretch it out to 3 to 5 years.
All right, Bright, thank you so much for your time. Let's leave it there. That is Bright Khumalo from Investec Asset Management. That's it from me. We're going to take a quick break.